Great pleasure to be here. It's a pleasure to be back in Portugal. We've had a little vacation down in Porto and a lovely time here in Braga. And it's a great honor to be here at this conference. I've managed to get to some, not all sessions, which was impossible because, of course, many of them were concurrent, and learned a great deal about what's going on in the field, for which I thank many of you in this audience. I'm going to talk about something rather different. My friend Juan Palacios, on the way back to the hotel this noon, mentioned that he'd surveyed the papers, the list of papers, and that mine was the only one on personal finance. But I had to correct him. This afternoon I was able to hear a very interesting study of structured products for retail investors. And so I think now this is the second on personal finance, but it is definitely still in a minority. What I'm going to talk about is a prototypical situation, and I'll keep it very simple. You're going to find this talk very simple, which is good because it will help your, it'll be a sort of a digestif before dinner. Very simple, but in the US and perhaps, unfortunately, increasingly in other countries, a very, very, very important problem societally. The problem is one in which an individual may have a social program which will pay a certain amount per month until he or she dies, but has had to save money through some sort of perhaps institutional system, through their retirement plan, let's say at an employer, and is now faced at retirement with a certain sum of money and decisions to make. Do I buy an annuity? If so, what kind? Do I not buy an annuity? If so, how do I invest the money? What is my rule for spending it over the years in my retirement? That problem is being faced now by a great many people who are not wealthy and certainly not sophisticated in terms of finance in the United States and increasingly in other countries. In the US, as many of you may know, our social program is not as generous relative to salaries as in many of your countries. So individuals have had to have some supplemental program, which until relatively recently was like the social program in that you received an annuity upon retirement. But for whatever reason, I think some fundamental reasons, we have shifted, as increasingly other countries are contemplating or actually doing, to a regime in which the individual has to decide within limits how much to save, how to invest it up to retirement, and then is faced with the decisions that I'm going to talk about today at retirement. So I submit to you that certainly in the States, this is a very important class of problems. And what I'm going to talk about is the gap between the way economists have looked at this problem and the way in which the investment industry, the financial institutions, are beginning to address it. And I'm going to give you some examples. You're safe. I'm not going to create an objective function and find an optimal solution. I'm capable of doing that in certain settings, but I'm not convinced those settings are particularly relevant. So it's going to be quite a bit more pragmatic. But hopefully I will give you a flavor of some of the solutions that are being offered by various players in the financial markets in the US. Now, I'm going to do simulations, of course, I need a capital market model, and I'm going to use one that goes back at least to Bob Merton, to Mark Rubenstein. I'm going to throw in some elements, I think, that I attribute at least to Phil Dybvig. So it's going to be pretty simple. It's going to be discrete. And I'm going to follow the tradition in the industry of using annual periods. In the industry, there is a tendency to, at the beginning of each year, establish an amount to be paid out per month for the next 12 months, and then reset every 12 months. So I'm going to follow that model. And I would just suggest to you, if you are ever in a position to give advice to your aging parents, or for many of you, your grandparents, who may be faced with this sort of decision, you're going to need, implicitly or explicitly, some model of the capital markets. And we've heard a lot of models, partial and in some cases complete, in the sessions here. But you're going to find this is a very old-fashioned, simple kind of model. But I think there's something to be said for using something of this genre in addressing these questions. I'll let you be the judge of that. I'm going to have two investments. One is risky and one is riskless. And they're just going to be numbers, of course, in my examples. But here's how I think of them and how I think one should think of them as a practical matter in many cases. The risky one is a market portfolio, by which I mean all the stocks and bonds, preferably in the world. And I'm going to deal with everything in real terms because for this problem, it is really purchasing power that matters. We can get in arguments over the index, but so I'm going to think of that as a highly diversified, risky portfolio, sort of the societal, traded, risky portfolio, with everything in proportion to outstanding, as of course you would imagine. And my riskless asset is going to be some sort of default-free, we hope, inflation-protected security. In the U.S., the securities issued by the government are called Treasury inflation-protected securities, or TIPS for sure. Why am I doing this? Is my mic on? It isn't. That's why I'm doing it. Let me put on my lapel mic so I don't have to. Am I on? Can you hear me in the back? Okay, that's a little better, I think. And I'll call them TIPS. And to make it simple, I'm going to assume that zero coupon bonds exist for every maturity. And to make it even simpler, today at least, I'll assume they all carry the same rate of interest. So there's no term structure issue. You could add that. Why is that there? I just went to the end. Help me. Sorry. That's very dangerous. I need to go back. That's fine. I can get there. Thank you. Okay. No, page down is above end. Will you remind me that, Chaim, if I forget? Okay. All right. First thing, the stochastic return process. I'm going to use, when I say return, I mean 1 plus return. So a return is 1.01, or sometimes known as a value relative. So obvious thing that compounding is important in this problem. The value at the end of t periods is the product of the returns, in my sense, for those periods. Equivalently, the log of the total return for t periods, v sub t, is the sum of the logs of the returns for the subperiods. Now, why do I emphasize that? Because the simple rules that we use sometimes in portfolio construction don't work here because returns are compounded, and that's an essential element, as probably you all know, of this problem. We're talking about returns up to 30 years out, and compounding is a very crucial part of that process. Oh, I did it again. I'm sorry. How do I start? There we go. You're going to have to discipline me here. Can I use that? Yes. That's much safer. Thank you. You wouldn't know that I do my own programming, would you? I can't even handle a laptop in Portugal. So here are my numeric assumptions. Some of the things I'll say are somewhat sensitive to this, but not too much. I'm going to assume a real rate of 1% a year. Isn't that depressing? But I couldn't give this before people in the real world and use the usual academic assumptions of 2 or 3% when I know what the real rates are, at least in the US. I'm going to assume the market portfolio has a risk premium of 3.5%. Remember, this is bonds and stocks. Standard deviation of 10. Remember, again, it's bonds and stocks. And that's got whatever that ratio is of 0.35. And let me just say, I did not name it that. Somebody else did. So that's basically, on the other crucial thing is, I'm going to assume that returns are IID annually. And IID, every year you draw from the same distribution, independent, identically distributed, and that 1 year distribution is log normal. And since the multi-year horizon distributions will converge to log normal with IID processes, no matter what the annual distribution may be, I'm just going to make it simple. Any horizon from 1 year up is going to be log normal. Okay. And if you want, if you're uncomfortable with that, you can think of the 1 month distribution as being skewed or having a fat tail or whatever. But the 1 year distribution, if those monthly returns are IID, will be surprisingly close to log normal. It's amazing. Somebody mentioned this in a session earlier. Okay, now, for forecasting, that's all I need. For pricing, I need a pricing kernel. I need some pricing function. It will perhaps surprise you that I'm not going to use anything that has anything to do with the capital asset pricing model or mean variance analysis. That was then, this is now. I'm going to use a pricing kernel. And just a couple of observations, and let me just define my terms for those of you who may not be familiar with this technology, and this goes way back, actually. Good Lord, I'm done. Questions? Never mind. M is, that's a vector, but I think of this as the price per chance. It's the state price today of getting $1 in a given future state divided by the probability that that state will occur. And so economically, I think it's important to think of the pricing kernel and the elements thereof as price per chance. And I want a couple of things. First, I want the market portfolio to be efficient in a 1 period horizon, which means the first equation must hold. The 1 year pricing kernel for year 1 must be some sort of monotonic declining function of the total return of the market portfolio in year 1. Ditto for year 2. Now, I also want, for reasons that you may quarrel with, but I want the pricing kernel for a T-period horizon to be a function, monotonic function, of the T-period cumulative market return, which is to say, in a 2-period case, I want the pricing kernel for period 1 times the pricing kernel for period 2 to be a function of the product, R1, R2. And pricing kernels are multiplicative, as the last equation emphasizes. Now, you might say, well, of course, that still gives you lots of degrees of freedom. But it turns out it doesn't. It turns out that it gives you this. It turns out that the pricing kernel must be related to market return in any single period, as the first equation shows, over a horizon of T periods, as the second equation shows, or more simply, the log of the pricing kernel must be linear in the log of cumulative horizon return, often known as an isoelastic pricing kernel. And that's equivalent, many of you, if not all, know to assuming the representative agent has constant relative risk aversion. But it turns out if you want path independence, you're pretty much stuck with this with IID processes. And that's what I'm going to use. And I won't bore you with that. I'm going to use 1 million simulations in my Monte Carlo just because I can. I think I get the award perhaps for this conference. I've been to sessions where people use 10,000, 50,000, but I think I've got the prize for that. If you use MATLAB, you can do anything. Some of you may know, many of you know. Now, I'm not going to explicitly talk about utility functions, but I want to tell you, in a sense, why. The workhorse of the economics literature until fairly recently in this area has been what I've shown in the top, time-separable utility. The X's are consumption in period 1, period 2, period 3. They're random variables, of course. The F's are utility functions. F1 of X1 is the happiness I get today from contemplating getting X1 a year from now. Ditto, ditto, ditto. And the objective for someone with this kind of preference is to maximize the sum of the expectations of those time-separable utility functions. And that turns out to be a lovely assumption to make about an individual's preferences. However, and makes it, you can optimize, you can do wonderful things. However, as I look at practice, and this is not just practice in this field, but practice in endowments of universities, I'll say something more about that, practice in pension funds, people do not act as if they have time-separable utility functions. They act as if one of or both of two things holds. Possibly they think that returns are mean reverting, that they are not ID, in particular not independent, or they believe that the sequence of consumption matters in addition to the actual amount in each time period. That they have some sort of a maximand in which there is some general utility function over the whole vector of consumption, and they want to maximize the expectation of that. And Chaim and I have talked about this, at least by email. So for that reason, I'm going to show you I'm going to show you 3 graphs for every strategy, and you'll I think, see why. So let me get to my examples, and I could and in time probably will do many more of these, but let me just give you a little flavor. I'm going to start with some funds offered by one of the largest mutual fund companies in the United States, which they introduced, are you ready for this, in 2007. And it won't surprise you, these have not become very popular. So this is not a major part of the financial landscape, but the funds still exist, and they happen to be very good for what I'd like to talk about. And the deal here is you give them your money, it's a mutual fund, and they will write you a check every month for, say, 30 years. Now, it's not obligatory, so you can change, you can pull your money out, so it's not like an annuity. But the thing is that they have not only an investment strategy, but a spending rule. And that's what I'm thinking of as a post-retirement financial strategy. And so I think it merits looking at it. And if you look at the prospectus, you'll see a table from which I've drawn this graph that says in the first year, we will pay out, at the end of the year, we'll calculate something like 4% of the then value of the fund and pay you that amount spread over 12 months. Then the next year, we'll look at the value and pay you 4.5% of what that is. And in the last year, of course, we'll pay you everything. So it's a predetermined, non-stochastic ratio of spending to asset value. Okay? On the investment side, they use what is known as a glide path. Many of you are familiar with this. This is from their prospectus. When you start, you have 65% equity, 30-some% bonds, and some cash. As you get closer to the 30-year point, you get more conservative. And this is widely used in the States and increasingly elsewhere for accumulation vehicles. And as many of you know, there's at least an economic rationalization for this, because if you think of your human capital as more bond-like, and there was a session on this earlier, then it makes sense to adjust your financial capital to complement your human capital, and as those ratios change as you get older and still working, this may make sense. I can think of no rationale for using this after you're retired. It's certainly not that rationale. But we see this being proposed by many in the financial industry post-retirement, and that's something that you may want to consider and do research on. Okay, so I've created a product of my own using some of these parameters, but in my setting, which I'm calling FIDO, Fidelity FIDO. It gets worse, by the way, just so you know. And so here are the proportions. I'm investing over the 30 years. And by the way, 30 years is very typical among financial advisors. They want to make you a plan with a 30-year horizon. And you might say, well, what if I die in 15 years? I'm going to come back to that, but let me just say now, everything I say until the very end could be applied in an annuity product as well. So don't tune out for that reason. I'll make that point briefly. So anyway, so here's my mapping of their glide path onto my two assets. Now, we all know that it's very deceptive to summarize probability distributions in any simple way. I think we would all like to show somebody who's contemplating a probabilistic outcome the entire probability distribution. Here's my version. This happens to be the amount you would spend in this plan in year 30, viewed from today. And it looks like a cumulative distribution upside down, and it is. And that's because behaviorally, we tend to find, and I've done some work with behaviorists, so I know just enough to be dangerous, but we tend to find people want to answer the question, well, what's the chance I'll have at least $40,000 a year? So you can look up there at 40,000 and say, well, oh, 85% chance. People tend to internalize these issues. What's the chance I'll have at least this much to spend? So when I show probability distributions to human beings, I tend to do it this way. And you can sort of get away with that if you only have one outcome. But we're going to have 30 outcomes, expenditures in each of 30 years. And so I at least have not found a way to get human beings to look at 30 probability distributions and internalize it. So I'm going to use something that is similar but not exactly the same, as you often find in the industry. If you look at the year 30 out here, there, the bottom says, well, you'll get at least that much, 99% sure you'll get that much at least. And the top says, there's only a 1% chance you'll get more than that. So I've just taken some points on the distribution. How you select those points, many of you can anticipate, will affect the choice your investor makes. We love to think investors come to this problem with nice utility functions, and we can then optimize. But I can tell you from work I've done with cognitive psychologists and many others' papers, they don't. And you can change their choices by changing presentation. And there's some really fascinating work that's being done in that area, which we can talk about another day. Anyway, so here's Fido. What you can see, look at from today, there's a fairly narrow, not very narrow, but fairly narrow. By the way, this is for somebody with $1 million. And so the scale here is you can spend $55,000 to $65,000 with a probability 0.98. But again, looked at from today, the range of things that could happen when you're really old, if you're still alive, or to your children, if you're not alive, is very, very wide. Now, is that something someone should want? I don't know. It depends on the person, but nonetheless, it seems to me that it would be useful for somebody contemplating this strategy to at least look at this picture. There was a survey done just within the last few days that I read about in which most financial advisors surveyed do not try to project more than a year or so anything about whatever they're proposing for people in this situation, which probably is good sense, and their lawyers probably told them not to. But I don't think that's very helpful. Okay, here's the second, and by the way, that graph, or at least what's beneath it, is sufficient for someone with time-separable utility. If you know the probability distribution of spending in each year, you can evaluate the strategy, period, end of story. But for these other folks I mentioned, I offer this graph. It's not scientific, but it responds to things I've seen over the years in dealing with pension funds, endowments, and other long-term investors. They want to know what would be the change from year to year. How much worse could it get next year than this year, or 6 years from now versus 5? So all I've done here is taken the distribution of the spending in each year to the spending in the prior year. So each of these distributions is viewed from the prior year, not from today out. And that, for people who are concerned with the sequence, this, I would assert, would provide at least useful additional information. Oops, that doesn't do it, that does it. Okay, I want to say something about lockbox strategies. This is something I've written about some while ago. And how much do I want to say? Not very much. And the idea here is this would be a strategy in its simplest form. You have a lockbox for every future year. So there's a box for the year 2020. You put some money in there, you put some securities in there, maybe you put some instructions in there to your financial manager as to what to do with those securities between now and the year 2020. In the year 2020, you open up the box, you cash out the securities, and you live on it. So for every year, there is a separate box with a separate investment and perhaps a separate investment strategy. Okay? And in a complete market, and I'll say a little bit about that, any strategy can be implemented in principle in this manner, for reasons that won't be too surprising, perhaps. Now, here's something that at least didn't pop out to me when I first looked at it. The fidelity strategy can be implemented simply and straightforwardly as a lockbox strategy. And it's just a matter of rearranging. In this, X1 is the amount you spend in period 1, R1 is the total return in period 1, W0 is your initial wealth, P1 is the predetermined payout ratio for year 1. So if you just rearrange the terms and then go to period 2, what you can see is you can interpret the whole fidelity strategy as a lockbox strategy, and I think later I'll show you the amounts in each of the lockboxes at the initial period. Just hold that thought. So I want to talk about valuation. I've got a pricing kernel, so I can value anything. And that doesn't mean you can actually go to marketplace and buy and sell contracts, derivatives, structured products at those prices. So I want you to think of the present values I'm going to compute as kind of abstract, interesting numbers. I don't want to bear the burden of assuming that you can actually transact, nor do I want to assume markets are complete. There's a whole set of things you can do without making those assumptions. I'm not going to try to do that. But I do want to point out, looking at the FIDO strategy, here is year 30. On the horizontal axis, I'm doing this in logs. The pictures are uglier without logs. Of the cumulative market return 30 years out, on the vertical axis, the log of the payment. And what you see is it's not monotonic, it's a cloud, which is to say that the payments are path dependent. They depend not only on the cumulative market return, which, remember, we assume is the only thing priced, but also on the path. Equivalently, price on the vertical axis, payment on the horizontal, that's not monotonic. That's inefficient. And the simplest way to sort of think about this, and I think this came from Phil Dybvig, is if I'm going to do the following. I've got 1 million spendings in year 30, spending amounts. I'm going to sort them, same exact amounts, all million, from the biggest to the smallest. And then I'm going to assign them to states I have 1 million states of the world, based on the cumulative returns. So I'm going to take the same 1 million payouts and arrange them so that I can get them in the cheapest possible way. So the biggest payout I will get in the state with the lowest price, which is the state with the highest cumulative market return. And so that's what I've done here, and this is the graph I promised you. On the vertical axis here is the present value of the payments in each year. So if you look at year 30 here, that's the amount, the total bar, including the little pink, is the total amount to put in the lockbox for year 30. And that comes straight out of the fidelity payment strategy. But there's a little part there, and you see it's really little, the little purple part. That's the inefficiency in that I can get that same exact probability distribution for that year a little cheaper by arranging a strategy which gives me payments which are path independent. Now, if you do that for all the years, you see that you can't even see the inefficiencies until you get out a ways. So what that's saying is the glide path is inefficient in that it provides a more costly way to get what matters to someone with a time-separable utility function. But in this case, at least, it's not very inefficient. The total cost of the path-independent alternatives is 99.7%. And as I've played with some of this, I used to think this is some place that economists could really, berate people in the industry. Look, you've got these inefficient strategies, you've got glide paths, you've got all this foolishness. Look how much money you could save, and at least for some people, not be worse off. First of all, not all people have time-separable utility. Second, when you do these calculations, these inefficiencies, I find, are not huge, although I'll show you some that are a little bit bigger. Let me talk next about another industry offering, which is quite different. This comes from another mutual fund company, Vanguard. And they also have a payout system, but it's very simple. And they have 3 funds. I'm going to concentrate on one of them. Look at the middle fund. This is a fund where they invest 75.3%, give or take, in stocks. So it's a sort of a moderate. It's a little riskier than our market portfolio. And then every year, at the end of the year, they take 5% of a value, hold that thought, and then that determines what they pay out over the next 12 months. So it can go on forever, which presumably is fine for rich people and for Vanguard. Oh, wait a minute, okay. I spared you a lot of intermediate slides, I'd forgotten that. But they have this very interesting thing. They multiply that 5% not by the current value of the account, but by a 3-year rolling average of the past values of the account. Now, this may sound familiar. A recent survey within the last month showed that among U.S. university and college endowment funds, 75% had a strategy like this. The amount that you pay in a year is a function not of how rich you are today, but on average how rich you've been in the last 3 years. As many of you know, that put a certain stress on the systems after the market decline in 2007 through early 2009. But standing back as an economist, or if you, like I, have had the misfortune to serve on the boards of some of these endowments or have lunch with the treasurer of your university, why would you ever want to do that? Why would you ever want to spend as if you were richer than you were? Or for that matter, spend as if you were poorer than you were? And the usual answer is, well, the faculty don't want to have their salaries cut. But that's not really a sufficient answer. Now, I think, and by the way, you see the same thing in pension funds. I think there are special reasons with endowments that have to do with fundraising, and I don't want to go down that path. But I think either this reflects a possibly misplaced, as I'll argue, desire for smoothness with an uncertain investment strategy, which I think is ultimately incompatible, at least in large part, or an implicit expectation that markets do have a tendency to mean revert. If the market went down, you don't want to cut your spending too much because the market's going to feel sorry for you, and it'll come back next year just because it felt so badly that it made you poor. Now, I'm using that in a pejorative sense, but I think there is this theory, this feeling. Now, if you want to model that, you're going to get different results than I'm going to show you here. What I'm going to show you here is based on IID process. Okay. And you can judge that for yourself. So what I've done, and this is sort of forced, and in retrospect I don't like this, I just took the FIDO strategy with all the details we looked at and just changed it so the payout from the FIDO rules was applied to the last 3 years. So I put in the historic average valuation, but left everything else the same as in the first example. And what you see here is that there's a wrenching change in the final year, partly because you're using stale values and you've been diminishing this fund. But more importantly, and I know this is really hard to see in the back, but I've compared here, the red are the FIDO where you use the current valuation, the blue is the 3-year average. And what you see is, yes, in the early years, you have reduced the uncertainty of your spending. But in the final years, you've increased it. And again, it's a sort of, and I'm being very mushy about this, it's a kind of a conservation of risk. If you're going to take a certain amount of risk in your investments, it's going to come out sooner or later in a situation like this, which has a finite life. Okay. Is it inefficient? Yeah, it's a little less efficient. But I was surprised it's not that inefficient in this least cost sense. Okay, I want to talk very briefly about this. If you're interested in this, I would ask you to go to YouTube and type in "the wrong financial advisor," where you will see a 5-minute cartoon video that I produced after a couple of nights of lack of sleep. It's supposed to be funny. You can decide. Oh, and by the way, for those of you who would prefer, Juan Palacios has done a version in Spanish. So we have. But I want to tell you a little bit about this. This is a rule which is used by probably a majority of financial advisors to individuals. Now, these are wealthy individuals, let me say, by and large. And some variant of this is very, very popular. Here is a little example from the Vanguard website, which I put here just in case you feel that you're inferior to people in the industry. This will make you feel that you're much smarter than they are. So pay attention. So you go to this site and you say, I have $1 million. I want to invest in a moderate asset allocation, and I'm going to have 30 years. And you press the button, and it will say, okay, take out, if you have $1 million, take out annually for $47,500. The last figure is just per month. And then next year, write yourself a check for that amount plus inflation. So it's basically you take a payment which is constant in real terms until the 30 years ends, or you run out of money. And why do they recommend that? Well, because they have done an optimization. And what did they optimize? They used 83 scenarios, not 1 million or 10,050. They used 83. And they found that with 83 scenarios, you could spend that amount, and in 85% of those scenarios, you would not run out of money. That's the problem they're solving. Now, where did they get the 83 scenarios? They used history. Sounds good. They started in 1926, where their data started, and they used the next 30 years. That's scenario 1. Then they started in 1927. But when they got to the latter scenarios, they didn't have any years left. Not to worry, we'll go back to 1926. Okay, so if you think sometimes what we do is not scientific, it could be worse. Okay, so here's my version. I'm calling it Quattro because it's 4%. Their version in this case was 4.75, but they all have this character. What you see is it's great. You get your 40,000 real for sure until you don't. Then there are scenarios in which you just run out of money. There are also scenarios in which there's a lot of money left. Good for the children, good for the charities, and really good for your financial advisor. Same thing, okay. Now here is the value in each lockbox, and this may surprise you. You would think maybe the value would just decline with the present value of the riskless asset, which is, after all, a 1% return. But what happens is, in the latter scenarios, in the latter years, there are scenarios in which you get nothing, and some of those years are years in which the price is really high, bad scenarios. So the present value of those out years, those latter lockboxes, if you want to think of it that way, is considerably lower. And since it is not entirely path independent, far from it, the inefficiency is greater. So the overall inefficiency, looking only to the 30 years, is 96%. But wait a minute, there are a lot of scenarios where there's money left. Here's the same graph, but I've included the money that's left. And you see that, in effect, you're putting over 10% of your present wealth in a fund to finance your children or your charities. And furthermore, there's so much path dependence out there 30 years, it's pretty inefficient. So overall, I don't have the number here. But so why would anybody want to do that? Well, maybe you as an investor might not, but the financial advisor loves this, because there's lots of money to manage, lots of fees to be earned for a long, long time. Okay, I'm going to just show one simple one. I'll call it buy-ho, because I'm into that mode. This is just something I threw together for you. What I've done here, I've used lockboxes, and I've started by putting the amount in each lockbox, which would give me the same real income every year for 30 years. So if I took the total amount, which is up here at the top of each bar, if I took this, sorry. If I took that amount and put it in tips every year, then you would have a constant income in real terms. But instead of putting, so that's how much I put in each box to start with, but instead of putting just tips in each box, I started in the first box, I put half the money in tips and half in the market. And I just left it there until the end of the year. In the second box, I put less in stocks, both proportionately and in actuality, and so on. So, and what did I use? I used just the square root rule of T. I had a motivation, but I just did it. So in each case, so let's look at the lockbox for year 15. I put this much money in, of which this much was in tips, and the rest was in the market. And I call it buy and hold if, in fact, you could invest in an index fund for the market and invest in tips with a 15-year maturity, zero coupon. Literally, it would be buy and hold. There would be no transactions whatsoever required, and presumably no fees to a money manager. None of what I've shown you has any fees taken out. And if you do that, I can guarantee you the inefficiencies become much greater. So in any event, so here's the strategy. It's extremely simple. It's really easy to understand. What am I going to get in year 30? Well, whatever those tips plus those stocks grow to, period. And it's cheap. Okay, so here are the distributions of payments. Yes, there is a greater range for the out years, the later years. But of course, as we all know, the range of state prices for year 30 is much greater than the range of state prices for year 1. So in some sense, even if you have risk aversion, and even if your risk aversion is increasing through time, you are likely to probably, in a typical optimization, end up with something that might look like this. The year-to-year variability is pretty small, not zero, but that might be sufficient for some. Okay, the last comment. And again, you can do this, and I plan to do this probably for the rest of my life. I've got all these programs I wrote, and I can just take anything I find in a prospectus. One of the things I want to look at there's a whole set of products, and this relates to the structured products discussion we had earlier. There are a whole set of products that are offered by insurance companies and investment bankers which have minimum floors. You know, they're very complicated. I've told some of you, I have a friend who's a financial advisor, and he loves some of these products, and I said, oh, that's great. Can you explain it to me? And he tried and failed. And I said, well, send me the prospectus. And he did, and it's 183 pages. And I haven't read it yet. But there are all these products with guaranteed minimums, et cetera, et cetera, et cetera, conditional on this, conditional on that. And so one of the things I think might be instructive, and they have fees. They have a lot of fees. And one of the things that might be instructive is to use this little engine to maybe look at some of those, at least pro forma. But here's the point I want to make. Obviously, if you're rich, you don't need annuities. You can just leave anything that's left to your kids, to the local festival, what have you. I didn't go last night. I just want to know. However, about midnight, one of my Australian friends said, we're going into town, mate. You want to go? I said, no. My wife and I went to bed. But in principle, an insurance company or the government or anyone else could take any of these strategies and make an annuity out of it, which is to say, get a bunch of people together of the same age, the same sex, the same mortality prospects, and say, look, we will make these payments available to you if you're alive. And so I just sort of did one last graph. Very simple. This is for a single male, 65 US tables. I'm assuming here the insurance company charges you $1.15 for every dollar of value using the current tables. I'm being very careful about that. And you can say, why do they charge you 15% overhead? It could be because they're protecting against table uncertainty. The mortality table could be wrong, or it could be because they have all those nice people who come to your house and tell you about the product, or it could be that they're just greedy. 15, 20, that's a sort of a standard industry assumption, at least in many studies. Because of that, I'm not going to start, this is a 65-year-old, he's not going to annuitize until he's going to take a deferred annuity that will start at 74. There's no point in paying an overhead for an annuity when you've got a probability of being alive of 0.99. And what you see here is the present value of each of the payments by year. In this case, the underlying strategy is all tips. So it's a strategy in which you're locking in a constant. It's a traditional inflation-protected annuity. Same dollar amount in real terms every year for 30 years. And the present values, of course, decline because of the present value of money. So the blue is what you would pay if you were to do it without an annuity. And the yellow is what you would, the sum of the yellows, which is about 2/3, is what you would pay if you annuitized. And you can think, I think of these as sort of polar cases. If you don't care about anybody that you might leave money to, then you take the yellow. You can either save 30% and go spend it, or you can get 50% or so more every year. On the other hand, if you get just as much happiness thinking about your children spending your money as you do about thinking about yourself spending it, go for the blue. Don't annuitize at all. Now, of course, normal people are somewhere in between. And so if you try to write down a sort of a simple problem, find an optimality, you need different utility functions for you versus your heirs. And you can do that, and people have done that. But what I'm finding is that people have acted for a long time in the institutional investment world as if they really do care about the time sequence. And so you want to be a little careful before you make sweeping generalizations about results that hold under time separable utility, although they may still be the best strategies. This is an area of increasing importance. I hope I've convinced you the industry has a long way to go, pretty good, a long way to go to get it right, or to offer a range of products that's appropriate for a range of individuals. I think we finance people, we economists, we financial economists can contribute a lot in this area, and it's really hard, and I hope that some of you will take up work in this area, and I look forward to reading what you produce. Thank you very much. Great. Thank you very much. Thank you. All right. Thank you.
Thank you.
Thank you.